In business, we're going to be using ratios to help us understand final accounts and look at businesses. And the first one we are going to look at is the gross profit margin. You might hear it referred to as the gross profit percentage. It means exactly the same thing. And what we're going to be measuring today is how much of each pound earned by a business is kept as gross profit. Or another way of looking at it is how much it spends on its cost of goods sold, its cost of making the item. So we are going to look at the income statement. That's the only final account we're looking at today to get the information. And the information we're going to take is, we're going to look at revenue, we're going to look at cost of goods sold, and we're going to look at gross profit. So I've got an example going along here. So the revenue is the money your business has earned. The cost of goods sold are the cost of making the items. So if I was a car factory, it would be the cost of buying in the wheels and the windscreen wipers and stuff. And the gross profit is your revenue minus your cost of goods sold. So for our example today, we've earned £1,000 as revenue. We spent £300 making the items on our cost of goods sold, and that gives us a gross profit of £700. We today are going to find out as a percentage what is their gross profit compared to their revenue. Now, the way we're going to do this is we're going to take our gross profit figure, we're going to divide it by the revenue, we're going to times it by 100, and that will give us our gross profit margin. So pretty much, if I'd spent £1 at this business, how much of that pound would be kept as gross profit? So for this business, we're going to take the 700, we're going to divide it by the 1,000, the revenue, and then we're going to times it by 100 to make it a percentage. So it gives us 70%. So every pound earned, 70% is kept as gross profit, and 30% has gone on the cost of goods sold. Now, we don't know whether it's good or bad, but we have calculated it. So what we're going to do now, if you carry on, we're going to find out about how we can use this. We're going to be able to compare a business over time. If we look at this particular business here, we've got 3 years worth of financial information. We've got the revenue, which has gone to 1,000, 1,500, and then to 2,000. We've got increasing cost of goods sold, and we've got increasing gross profits. You look at this and think, my God, revenue's gone up, gross profit's gone up. We are brilliant. But we're going to use the gross profit margin to see if this is really the case. Remember, we're going to take gross profit, we're going to divide it by the revenue, times it by 100, gives us our gross profit margin. And just like the one we did before, we're taking 700, we're dividing it by the 1,000, timesing it by 100, and our first gross profit margin is 70%. So pause this video now and have a go at working out the next 2 years' gross profit margin. So hopefully you found 800 divided by 1,500 times 100 equals 53.3. Only go to 1 decimal point. Life is too short to go any further. So even though their revenue's gone up and their gross profit's gone down, they are actually keeping less of each pound. So this is a negative thing for this business. If we go to the third year, revenue's gone up to 2,000, gross profit's gone up to 900. Again, they're only keeping 45p in each pound. They are spending increasingly large amounts on the cost of goods sold. And if this was your business, you would be concerned to find out the reasons why. Because as a proportion, their cost of goods sold is increasing and increasing. So using gross profit margin is a really good way of analysing your revenue and your gross profit. And if you were running this business, it would give you areas that you would need to go and investigate. This business is not doing so well. So this is very, very useful for comparing things over time. Now, we can use it to compare businesses, but we need to be careful about this. So I have 2 businesses. I have a food shop and I have a hairdresser's. I have different levels of revenue, so it doesn't, as we're going to turn it into percentage, it's really good that the businesses are different sizes. That doesn't matter. So again, pause the video, please work out the gross profit margin for the food shop and then the gross profit margin for the hairdresser. Restart it when you're ready. So 110,000 divided by a million equals 11%. So in the food shop, 89% was spent on buying the food into the food shop. Only 11% was kept as gross profit margin. If we look at the hairdresser, they earn considerably less. If we work this one out, we have 250,000 divided by 300,000. They've got a gross profit margin of 83.3. That is so much better. But we can't really comment on this because they're in totally different businesses. The cost of goods sold for hairdressing is just a little bit of shampoo, really, whereas the food shop, they're buying all the food in and putting it on the shelves. So please be very, very careful when we're comparing the gross profit margin of businesses which are in different fields. It is not easy to compare this way, but you can, of course, if we had two food shops, compare their gross profit margin, and that would be perfectly allowable.